Hey, good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office May 2024 First Friday online meeting. Today's presentation is titled Artificial Intelligence, Identifying the Winners and Losers. Today's presentation will try to peer into the future and outline our base case for the development of the world's capital markets with the effects of artificial intelligence. As you can imagine, with every technological advance, there will be portions of the capital markets which benefit and portions which suffer. The one constant amidst every advance in technology is change. In our discussion today, we will do our best to identify the beneficiaries of this change amidst the portions of our economy that may be left behind. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be a bit shorter, at approximately 10 minutes long, as there have been a significant amount of questions from participants, which are incredibly worthy of answering. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box, or write it down and raise your hand at the end of the prepared remarks by clicking on the icon at the bottom of your screen. We really enjoy your questions, and we'll do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the May 2024 First Friday meeting for the Abernathy Group Family Office members. And I just wanted to put a little plug in that says this is our 17th monthly meeting, and today's topic, artificial intelligence. We're going to do our best to discuss the world's, I think, today, the world's most potentially disruptive change. And I think this is the most, I would say, disruptive change that we've embraced since the invention of the internet. As we discussed 2 months ago, while we don't believe artificial intelligence is as disruptive or transformative as the internet, we do believe it's an incredible step forward for mankind and will both increase efficiencies in our global business world, and it's going to allow us to make better, more informed decisions in every facet of our lives. Let me just take a moment to try to explain the logic behind that last statement. AI at our current stage of development is really what we should be calling advanced machine learning. I'm not trying to denigrate this technology in any way, yet I do want to call it what it is. Our current iteration of AI takes all of the information it's been trained on and produces answers based on that information. It's still, in my opinion, in its adolescent stages. So sometimes it gets answers wrong, and we must also, always be vigilant or diligent with our questions and demand recitation and the references that are backing the information AI uses to answer the question. And I think we need to continue to do this until it gets the bugs out, and it will. However, as we get the majority of the bugs out, we will continue to increase the data set this AI or the AI bots are trained on. And eventually, I believe we will have most or all of the information ever recorded in mankind. So it's going to be a big productivity and answer for sure. So a couple of things AI isn't. Just make sure that everybody's on the same page. AI is not sentient. It's not conscious. It doesn't create. It rather gathers data and orders it and gives it back to us in a unique way, in the form of an answer to a question, obviously, or a spreadsheet, or code it's asked to provide. The first order effects of this technology will be an increase in efficiency and productivity. That's quite clear. It'll increase productivity by allowing humans to do more with less. It may allow humans to be more creative, as answers to the questions will take less time and will be much more accurate. And with certainty, its accuracy will evolve over time. Since this is the first time we've really gotten into a discussion about this in depth, let's take just a moment to develop a categorization of how we think about the evolution of this technology. So as time evolves, more categorization will become very clear, and innovation is going to create more categories, each with winners and losers. So from the top down, and I think a reasonable way to categorize this technology is to clump it into three categories. First, the creators of the technology. Second, the enablers, which are sort of supplying the tools that make the technology work. And then thirdly, the implementers, which are the users or the beneficiaries of the technology. Creators, for example, are now well known, and many of the creators are on their third or fourth or fifth iteration of the offering. So they represent the DeepMinds of the world, the Googles of the world. You know, if you care to sort of ask Google, it will give you a very long list and of all of the creators, and most of the creators have priced in a reasonably rosy future, I would say, to be very conservative. The second order of category we can call the enablers. These are the companies that are supplying the equipment necessary to enable the technology to work or to actually implement the technology. This category of AI is equivalent to the historical, I guess you would say, characterization of supplying the picks and shovels for the gold rush. The high level categories that are pretty well known are the hardware, the components that go into the hardware that make the hardware work, and the software, which allows the hardware to offer data and information which we can use to make decisions. Lastly, we can group, I think it's safe to group the last set of beneficiaries as the implementers, or these are the users of the AI to produce products, goods, and or services. And as you're going to see, this is where the benefits of this technology will be realized most abundantly. And this is where the leverage really starts to take place. So considering the broad categories, who are the broad brush winners and who are the broad brush losers? And importantly, for the focus of this summarized overview, where are the opportunities for intelligent investors? So our next slide, I want to take a look at a very high level and be summarizing all the time. Let's just take a look at each of these categories through the lens of current valuation, which in my sort of mind creates opportunity or not. First, the creators. They were initially largely private, and they were well funded, and they have been at this for well over a decade. Most of the real creators have been at this since the early 2000s. While the creator category has expanded a bit since the initial adopters or the initial creators or implementers, most of the creators are fully priced or are still largely private, or they're a division of a public company which adopted the technology privately and has been working on this for years and years. So the summary is that the creators are representative of the first order effects, and they're fully priced or they're unavailable. Next, let's move on to the enablers. The capital markets have taken the opportunity to price in expectations of growth exceeding the boundaries of reality for most companies. And I mean that I'm being conservative when I say that. You know, when you're looking at companies that are hardware producers, that are cyclical, that are priced at 100 times sales, these are just these are ridiculous valuations. After all, as I said earlier, once the new infrastructure is built, growth is going to slow, prices will become competitive, and earnings will normalize, as this has happened over and over again with every technology, from the steam engine through the computer chip for 150 years. And each time the new technology comes onto the scene, it follows a very similar rhyming model. The third order effects are the most interesting. Corporate America will adopt this technology in varying amounts and with varying speed. It's reasonable to assume that those who adopt this technology and to weave it into their everyday activity, or to the everyday activity of the company, will experience the effects and the benefits sooner and most notably. So some examples of the early movers most likely to realize the benefits are companies like Microsoft, IBM, and Adobe. You know, there are many others. I'm not trying to single those out. Those are just several that have been very outspoken and it's easy to see the impact already. There are lots of others that I haven't taken the time to list here because most of you know about them, but other industries that are likely to be incredible beneficiaries of the pharmaceutical industry. They're going to benefit from discovering molecule activity faster and with less costs. Clinical trials will take place much more quickly, and right now it's probably $1 billion to $1.5 billion per clinical trial. I would bet that in the next 5 years we get that down to $500 million, which will potentially lower drug prices. The energy industry will identify deposits or energy deposits faster. They're going to find ways to capture carbon more effectively. And the software industry is another industry that's very easy or very understandable as a beneficiary, as code writing will become much faster and will use or demand fewer programmers. The bottom line is the list is long and it's inclusive, yet it's largely going to depend upon management's adoption and implementation of AI. So, who are the identifiable losers at this early stage of development? It's too early to tell exactly who this technology is going to negatively affect most significantly. Yet those most easily identified are sort of what we would categorize as the non-specialized employees. It appears that many of these employees will be out of work, yet it will take some time to get to this point. However, it seems clear that unless you are specialized and are adding value to your corporation, AI is going to find a way to increase productivity, which likely means fewer of those who aren't adding to a company's productivity. Other examples, which are clearly within the sights of AI, are educational institutions. As many of you know me, I've been talking about the anticipation of education training, or the costs of education changing since the 1990s. I will clearly admit to being early. However, AI offers no chance for the cost of any educational institution to remain stagnant. It's impossible. It seems highly unlikely that any geography with access to the internet will be incapable of having access to the best physiology professor, or history professor, or chemistry professor on the planet. It just seems incomprehensible to me, and I think it will happen sooner rather than later. So my guess for losers are that educational costs will plummet, and eventually each company will have a resident authority on all of their data and decision making. So education in specific, and corporations in general. I think that there will be another industry that will sort of sprout up here that will become a personal large language model that's specific to you as a person. So we'll call it a personal tutor that's available in every topic that you can imagine. So the bottom line is that employment in general will become pressured. This happened with each technological advancement for the last 150 years. Initially, employment is negatively affected by the increased efficiency. Then new industries are created and new jobs become available for those motivated to remain educated and informed. To summarize, so the first and second order of corporate America has already priced in the reality to come, I think. I don't think that you'd be, I think you'd be wasting your time working on that area. And in many instances, that first and second order of AI is overpriced. In some instances, the fairy tale, I think, is going to end in tears, certainly with the hardware vendors. Many investors in the years to come are going to be asking themselves why they paid X for price, X of a price for a company that they paid, and I think they're going to be very sorry for this. So for investors most likely interested in trying to become involved in this industry, the beneficiaries, which are priced reasonably from this point forward, are those third order beneficiaries, those companies who are able to harness and implement AI most effectively. So I know that's a very quick, maybe overly quick, and topic. So let me just stop there and take a couple of questions I believe I saw coming through here along the way, with any new questions that may have come in during this presentation. So Marissa, I think I saw there were some questions coming in. Can you let us know if what they are, if I did see that right?
Yes, I have two questions which have come in. The first question is, what will happen to our personal computers when artificial intelligence becomes the norm?
Good question, actually. Really good question. Well, I would say that for most people, AI is going to be running in the cloud. So I don't think it will affect them initially. However, over the next year, AI is going to move closer to the edge. So AI will not be only destined for the cloud. It will move out to the collection points where the wireless signals are sort of aggregated. in short, it'll move to the edge of the network. So, and that's because they want recall times to become faster and faster and faster. Eventually your PC may be able to run some of the AI queries on your computer itself, but that's going to take a lot of memory, and it's going to take the next generation of AI that will allow you to adopt or to implement that AI to your personal data. It's a real, I don't know, I would call it is a revolution, and it's going to take some time. And at some point, it's going to require you to purchase a new PC, which is optimized for AI. And just like for many who use their computer for gaming, they were required to update their computer for the graphics chips so that the computer game would run without pausing. It's normal, and it processors in the future will be optimized for not only the large language models, but they'll be optimized for the inference, which is really important portion of AI. My advice is to wait for a year or so. I'm guessing that in the next year, a year and change, they will have PCs that are hybrids or optimized for AI. And as I said earlier, the PC will be reborn again. It'll have its cycle. That could present an opportunity for intelligent investors also. So the combination of AI with cybersecurity demands, along with new infrastructure that's going to be available for sure, it's going to change. It'll at some point demand that you upgrade your computer. And I wonder if if that's helpful, then great. If not, if you have a follow-on question on that, and let's discuss it offline. Marissa, you said there was another question, maybe.
Yes. Second question. What does the U.S. Federal Reserve's decision this week mean to equity markets over the next year or so?
Yeah. The answer is I think that I don't know for sure, but I will tell you that U.S. growth is significant. It is being supported by legacy liquidity. This legacy liquidity is from the incredible amount of stimulus infused during the pandemic and shortly thereafter. So this excess liquidity increased consumers' bottom line, and they're still spending. There's still no doubt about it. I've seen reports that mathematically support the fact that sometime at the end of summer, the consumer will have run through these excess savings. But I don't know how much that is noise as opposed to signal. I will tell you that this excess liquidity has created a spending spree, which resulted in the most recent bout of inflation here. And with federal budget deficits continuing to run at 7% or more of our economy during a healthy economy. So a 7 to 10% deficit during a wartime is understandable. But during a time where our unemployment, is under 4% for 27 months in a row, and during 3% or 4% GDP after inflation, it is unsustainable. It is crazy to the level of unsustainable. In short, I was going to say inflation is likely to remain stickier than most realize. This is going to force the Fed to keep rates higher than they would like. Eventually, something in the economy is going to break, and the U.S. Federal Reserve will lower rates to stop the downturn. This, I am 99.9% sure is correct. We don't believe the Federal Reserve will allow the U.S. economy to go through a downturn because of the amount of debt the U.S. has accumulated over the last 20 years. And just remember, our current period, as I said earlier, is eerily reminiscent of the late 1960s, early 1970s. And during that time, if you can remember back, unemployment was at 4% or just under 4%, had been there for 2 years. The labor market was tight. Inflation was about the same then at 3 to 4% as it is today. And that wonderful economy was created by very low interest rates and significant spending by our government in the 2 or 3 years prior to that. What followed this period is what we'll call a Goldilocks period, was the 1970s inflation. And I don't need to tell any of you about the downturn this created. What I do want to mention is that the 1970s downturn took place with less than 500 billion in debt. It was about 20% of our GDP. Today, we have 34 trillion in debt, and it's closer to 125% of our GDP. The stakes, or the table stakes in this, are incredibly high. So while I don't know what our most likely future will be, the combination of our 34 trillion plus in debt, combined with our planned overspending of 1.5 trillion plus, it's actually closer to 2 trillion during the next year. It just, to me, it ensures that the U.S. Federal Reserve must lower rates. And you might ask, I know I seem overly confident of this, so you might ask me why. And what I would say to you is, financing 1 to 2 trillion in deficits each year, it's possible with our economy at our size and 10-year bond yields paying 1% or slightly less than 1% a year, as we have been doing largely for the past 20 years. However, today with 10-year rates at 5%, it's just third grade math unsustainable, and it will eventually end with a less desirable outcome for most than almost anybody on this call is thinking about right now. And with that, I'll get off. I'm not, don't want to be on a soapbox, but I'm really worried about the long-term effects of what this could cause. Marissa, anything new?
No additional questions. Thank you.
Okay. For everyone, if anyone has any follow-on questions and would like to talk this through, please feel free to give me a call. During the next week, we are going to start moving some things around, and I'd like to talk. I will probably call for a meeting to have with everybody so we can discuss some of the changes in allocation. We're moving up in quality again, and in anticipation that I just want to make sure that everybody is safe. Me and everybody here is safe to the extent that you feel that you need to be safe. With that said, good luck, God bless, and I'll talk to you soon. Bye now.